We've got Jahangir Aziz, Global Head Emerging Market Economics at JP Morgan. Lots to talk about, particularly the economic outlook as we head into a new year and new decade, looking at the growth expectations that everyone is keenly watching out for and counting down to the budget. Jahangir, great to have you with us. Good morning and a happy new year. We've kick-started the year with a bit of a bounce when it comes to the markets, expectations that things will improve. Right. But we still haven't seen, those measures being announced, whether it be on the income tax side, perhaps in the budget, maybe not. And I know you've also been talking about that in great detail, that we haven't really addressed the crux of the problem yet with regards to what's causing the slowdown here. What are you going to be watching out for from the budget, from the government or the RBI in terms of kickstarting growth this year?
So on the budget front, I think, we are probably going to see FY20 budget ending up somewhere around 3.8%. So they will probably use the 0.5 percentage point of GDP of leeway that they have under the Fiscal Responsibility Act fully. Now, all that means is that this year, 2019-20, the government more or less has used up all its fiscal space as far as I can see, which means that in 2021 FY20 budget, there has to be a meaningful consolidation of the budget deficit. We think the government is probably going to target about 0.5 percentage point of GDP of decline in deficit, which means that in 2020, FY 2020, the economy, rather than being supported by actual increase in fiscal stimulus, will be facing fiscal drag of 0.5 percentage point of GDP.
Actually saying a fiscal drag is what you see coming in, Jahangir. So when we're looking at growth bouncing back, that's not on the anvil at all. What's the kind of impact that then you foresee on growth going forward?
So we do expect, growth to actually bottom out. Yes, I can hear you. Sorry, there seems to be some sort of a connection problem. Abba.
Give me one moment. Let's just check that line. Okay, if you can hear me, Jahangir, do go ahead.
Sure. Yeah. So, we are expecting growth to sort of bottom out in this quarter or the next quarter, and then FY 2021, we should see a pickup taking place. But that pickup is going to be pretty much mild. One of the biggest drags is going to be the fiscal drag, about 0.5 percentage point of GDP, or perhaps even more if the government is actually, concerned about the increase in fiscal deficit. The only real support that is going through in terms of macro policies is the lagged impact of the 135 basis points of rate cuts that the RBI has already done, and probably another 50-75 basis points more of rate cuts that might be coming through in the rest in fiscal year 2020. Now, these are typically ones that take a longer time to impact the economy. More importantly, it actually needs to get transmitted into lending rates, which we haven't really seen. There's been some transmission of the policy rate cuts on corporate bond rates, but we haven't really seen that being transmitted into lending rates. So even the monetary impulse is pretty much mild as far as what is hitting the market or on the ground reality. So in terms of policy support, there's going to be far less policy support going into fiscal year 20. So all that we really need to depend upon is, how strong will the global recovery be, and whether India will manage to, take advantage of the global recovery and use that to boost growth up. So we are looking at 5% average growth rate in fiscal year 20 to go to 5.5% in fiscal year 2021. So there is a recovery, but it's mild.
For the longest time, we've always described Indian economy as an economy where demand was never a problem, supply was always an issue. For the first time, you can get a feeler that demand has collapsed, and demand has collapsed in aspirational sectors. It has, collapsed in key sectors. What is the out of jail card to bring demand back now?
So this is the critical question that I think not just India but all emerging markets are facing. So if you think about, how emerging markets, including India, has sort of grown over the last 20 years, it's more or less been on the back of globalization. So from early 2000, with the entry of China in the WTO, as supply chains started to expand across the globe, almost every emerging market country joined that bandwagon, and we rode that very, very strong globalization and global trade expansion that took place. Things collapsed in the global financial crisis, but quickly recovered. But somewhere around 2012 onwards, we have seen a steep decline in global trade. And if you track global trade and the pace at which global trade has fallen since then, more or less all emerging market countries have essentially followed that path. Put differently, emerging market countries, including India, essentially relied on a single engine of growth, which was demand from outside of emerging markets, mostly from developed market countries. And alongside that was this expansion of supply chain. That essentially is over. We haven't really seen any expansion of global trade, of any meaningful expansion of global trade taking place over the last 5-6 years. Not just that, supply chains seems to have all got saturated in the absence of any meaningful large technological changes that would require new supply chains to be built up. And on top of all of this, there is a political backlash against globalization in developed markets. So trying to depend upon that as an engine of growth is unlikely to bear fruit. So all emerging market countries now need to self-inspect, look back at their own growth models and try and look at alternative sources of growth. And this is what's the demand deficiency problem that India is facing. This is true for every emerging market country, and you can see that in global disinflation that is taking place. Every year we keep getting surprised by how low prices have declined, particularly core manufacturing prices. So this is a global phenomenon, and I think like all other emerging market countries, India too necessarily will have to start rethinking what are its growth drivers.
While demand still continues to be an issue, on coming back to the supply side as well, and coming to the RBI, Jahangir, we've seen food inflation hike up. They've been talking about the rate trajectory. I know you just mentioned you still see further cuts coming in. We've seen those OMOs, and yet there has been a lack of transmission. Again, that's been a bone of contention pretty much through 2019. What's the kind of move that you see now over the next quarter or so?
So my guess is that, I don't really think that this problem of lack of transmission is going to disappear. The lack of transmission is taking place when the financial market is flush with liquidity. The RBI has been very generous in providing ample liquidity in the market. It is much more to do with the fact that banks and non-bank banks, as we have been discussing now almost for a year, have serious problems with risk management, serious problems about capital deficiency, and that is what is holding back credit growth. But at the end of the day, even if we do take care of these supply side issues of capital efficiency, of risk management, questions about risk management, etc., we still have the basic problem which you were talking about, which is that there isn't really any meaningful increase or sustained increase in demand, which will induce corporates to start saying, okay, it is time for us to go back and start making massive, large capital investment. And so you're really back to that same problem, that unless we are able to show that there is a sustained demand increase that will take place over the next 4 or 5 years, and it's not sustained and it's not demand increase based by some sort of ongoing policy support, but genuine bottoms-up demand increase in demand, I would find it very difficult to see whether the credit growth will pick up, even if you take care of the supply side issues.
Jahangir, just a closing comment, and I'm not talking about India, I'm talking about the world, and some data point just will come up for the benefit of our viewers, but I'll read it out for you for context, Jahangir.
Sure.
We've looked at the 10-year paper in India. Last 10 years, it has gone down from 11% to about 7%.
Yeah.
In US, it has gone down from 6.5% to about 2%. Right. In Europe, it has gone down from 5.3% to negative yields. The point I'm trying to make here, Jahangir, is that interest rates cannot go any lower than this. If monetary stimulus for the world could be missing in general, how will the economy at a global level pick up? Because governments have a bloated balance sheet, monetary stimulus cannot kick in, growth is not great.
Right.
So what kind of decade are we staring at now?
So, I mean, let's look at the first part, which is can monetary policy play a role? I think in developed markets, we have seen the limits of monetary policy. But that's not the case with emerging markets. India has 5.5% interest rate. Why can't interest rates go lower? I will admit that there is a transmission problem, and that more and more the rate cuts are there, or more liquidity there is, the transmission becomes weaker. There are also supply side issues. I'm not contesting that. But I think this idea that monetary policy is ineffective in emerging markets just because it is ineffective also in developed markets, that's untrue. So we still have a lot of space to go. China has 4.5% 10-year rate. We have about 6.5% 10-year rate. Inflation is falling across the globe everywhere. Growth is slowing down. So I don't really see that why even 10-year rates can't go down. The reason why 10-year rates can't go down is because the government is not bringing down fiscal deficit in the case of India. So I think we need to sort of not keep blaming that monetary policy ineffective. But I do accept the fact that it is going to become increasingly ineffectual if that's the only string that we are pushing. And therefore, we need to look at some other variables and other things, other areas. And I think what is critically missing, and that no emerging market countries had to really face, was this demand deficiency. Most emerging market countries were always supply constrained because there was always developed markets to buy things that we would produce. Developed markets have aged. Demographics has taken over. They demand new kinds of things. They demand new kinds of products. It is not the same manufacturing goods that emerging markets produce that developed market, the aging population developed markets demand. So we really need to change not only a product mix, we need to find out new engines of growth. We need to look inwards and depend much more on domestic demand and much more on emerging market demand than depend entirely on developed markets providing that demand for us in order for us to produce and grow. I think that's the change that needs to be done. If that change is done, I don't see why emerging markets can't keep growing, may not be at those breakneck speed of the pre-global financial crisis, but definitely higher than where we are right now.
Thank you for joining us, Jahangir. Pleasure as always. Good chatting with you, and Happy New Year once again.
Sure.